As the stock market hits new all-time highs, it's a good time to reflect on our economy, which by contrast is spluttering right now. But with the expectation of interest rate cuts also comes optimism the economy will turn around quickly. Well, earlier I spoke with Trobe Financial's Chief Executive, Chris Andrews, about ways to manage through these uncertain times. I just started by asking him why stock markets are at a record when the economy seems to be so slow.
Ross, it is the trillion-dollar question. We've had interest rates go up across the world by 4.5% to 5%. Classic wisdom would say that should be a headwind for share prices, but we've just seen them gradually melt up. Frankly, I think investors have been a little bit sanguine about the risks that continue to mount: geopolitical tension, market pressures, record valuations, and interest rates that are still staying a little bit higher than folks expected for a little bit longer. So there's a lot of work still to be done to work this through the economy over the next 3 or 4 years.
Do you get a sense that investors are basically riding on those interest rate cuts? Now, they've seen them in America, in New Zealand, in Europe, but we haven't seen them here. They're more stubborn before they're coming here. Is it really an anticipation that those rate cuts will come and maybe there's greater profitability, greater or better economic times ahead?
That's the hope, Ross. There's no doubt investors have that. My concern is if you look at interest rate futures here in Australia right now, they're pricing in 80 basis points of interest rate cuts by the end of next year. That's very inconsistent with what our Reserve Bank is telling us their expectations are. Now, there's lots of things that could unfold. Maybe we'll see inflation data soften. Maybe we'll see the unemployment rate start to move up. Maybe those sorts of moves will be justified. But I think investors now should be very careful about making too many assumptions about the trajectory of rate cuts into the future.
But the reality is, even investors in Trobe Financial, right, they're looking for rate cuts because generally the security is better, the conditions are better, property prices are generally better when rates are falling as compared with when rates are rising.
Well, that's one way of looking at it. I'll tell you another way though, Ross. For investors who are relying on reliable monthly income, when interest rates go down, their income gets a haircut as well. So there's a conventional narrative that lower rates are good for the economy. Lower rates are good for borrowers. Lower rates can be stimulatory for the economy as a whole. But for investors, particularly investors in fixed interest, sometimes that means an income cut.
So that's true, and indeed even right now there is actually a bit of pursuit for capital for those savings to come in. Now you'd be seeing it, the banks are doing it, you suddenly see some of the savings rates at banks getting out towards 5%. Yes. I mean, this is a point that you make, that there really is an opportunity for those people with a bit of spare cash right now.
Well, there's a really good opportunity in fixed interest when rates are higher. There's no doubt about that, Ross. And if you think about the big drivers now, if we're worried about valuations being at record levels, really do we expect that they can keep going up forever? We all know that can't be the case. So having an increased tilt towards defensive fixed income in portfolios, that seems to be something that investors should be thinking about really hard right now.
Okay, the one thing that has kept families going and probably has kept consumption going stronger than many anticipated is the fact that people have got jobs. Yes. And we've had skill shortages in Australia. Now that's a great thing for the nation, but the reality is if anything does start to turn there and business starts to turn down, people lose jobs. That seemed to be part of the economic cycle, but that also makes it much tougher, doesn't it, for families and for our economy to cope?
That's true, Ross. And I think when you listen to the Reserve Bank now, what you're starting to hear, certainly you're hearing it out of the Fed in the US, there's an advancing appreciation of the fact they're not just focused on inflation, they're also balancing that against unemployment. And you can expect to see that coming through here in Australia, I think, over the next 6 months. Because your point's absolutely right. Lower unemployment is really fundamentally good for the economy. It's good for our people, it's good for the development of skills, it's good for families, it's good for business. If that starts to creep up, now look, it's still at record lows. In truth, it could go up a little without doing too much damage. But remember, each percentage point is a significant number of people who don't have jobs. And obviously that's not something that's good for the country as a whole.
And it's not just the jobs that underpin families and therefore underpin consumption. It's also property prices themselves, which again have gone out to record levels in most capital cities, which again goes against the grain when you've had so many interest rate rises in Australia.
I think when it comes to property markets, Ross, what do we know about the Australian property market? Firstly, it's incredibly resilient. So you do see over time Australians really do put store in the value of their property. But it's a market like any other. And you can expect year to year, some years the property market will be up. Some capital cities, like Melbourne, for example, have actually seen property prices come back a bit over the last 6 months or so. So I think anyone who's thinking about a property purchase needs to do that with a very balanced perspective. This is a long-term investment. There's good reasons to believe that property in Australia is a wonderful investment. But certainly year to year, there will be ups and downs. And the wealth effect, the effect that occurs where people see property prices going up and therefore feel more able to spend, that's a real effect in the economy. And as property prices come off, that's something else that starts to slow down our economic growth, which again says investors need to think really carefully about how they're positioning their portfolios.
So in short, with all of this, over the next 12 months, are you an optimist, a pessimist? You're sitting on the fence?
Yeah, I'd like to be balanced always, Ross. One thing at Trobe Financial we always talk about is over time, investors cannot count on making those big macro calls right. What will happen with geopolitics right now? The world is sitting with a war in Europe, a war in the Middle East, tension in Asia, a really contested election in the US with a lot of polarisation between the political parties there. In that context, can investors feel really confident that they can predict what's going to happen over the next 12 months? Our answer is no. And what's the response to that? Always keep balanced. Don't tilt your portfolio too hard. Keep a balance of defensive assets and growth assets. Always stay balanced and stay diversified.
Chris Andrews, always good to chat to you. Many thanks for your time today.
Thanks, Ross.